Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Monday. It is December 20th. It is a holiday week. It is a fragmented week. We've got Friday off. The markets are closed. I'll get into all of that in a minute. As you could see here, the market is down pretty sharp. E-minis are down 50. NASDAQ is down 200. Dow is down almost 400. And this is after having a 500-point down move on Friday. So, but the good thing is I think we're going to see a little turnaround, and I'll explain to you why. First of all, the markets are very fragmented right now. There's just not a lot of news on the table because of the week, but we've got GDP on Wednesday. So I'm expecting a pretty subdued market till Wednesday, which means there's going to be a lot of uncertainty. And right now it seems like this new O variant is driving the market. Wednesday is going to be a huge day. We're going to have the GDP, the biggest report of the quarter. Consumer confidence. Again, consumer confidence is after the GDP. Why would somebody put a consumer confidence report after the GDP? Consumer confidence should go here. But who listens to me anyway? Existing home sales, all of these reports I'm expecting to be fairly on the nose. GDP is going to be the big question mark. The expectations, as you will see here in a second, let me give you what the growth estimates is. We're looking at about 2.1%. If the number is below 2.1%, or if the number's lower, the Fed may say, hey, we may need to keep the bond buying going for a little while. If the number's way hotter than 2.1, then the Fed has some explaining to do. But basically, the 2.1 is the target you guys should be looking at. Then we've got a slew of reports, including consumer sentiment. Again, I don't know who or why somebody would put consumer sentiment after consumer confidence and GDP. They are very similar reports. I would put consumer sentiment before, but again, nobody ever listens to me. And Friday, we've got the Christmas holiday. So again, it's going to be a fragmented week. I think it's going to start out really hot and end on a cool note. Now, let's talk about market internals and let's see what we've got in store for us today. Now, typically when the market is down this hard, you would expect the bond market to be really hot, really up strong. It's only up about 1/4 of a point. And as you could see here, the Fed already said we're going to be raising rates. I don't know really what the upside catalyst for the bond market is, but as far as I'm concerned right now, I'm really bearish. I'm short bonds in almost all of our programs. And I mean, the Fed is telling us they're going to pull out of the bond buying. We already know with the market down, the bond's only up this much. I mean, look at that. From 148.80 to 151, and the Dow's down about 1,000 points. On a typical move, that would really cause the bond market to spike. It's not spiking, which is telling me that the bond market is ready to cool off. And I'm just seeing similar here. You see a nice head and shoulder pattern. I'm seeing downside in the bond market. Again, it's only up 1/4 of a point, with the Dow down 366 points. That's telling. Put the call ratios random right now. It's not really telling us the market has bottomed out or has topped out. It's kind of in the twilight zone, which is telling me that a lot of the movement this week could be, let me say, how do I say this? Over exaggerated due to heightened volatility ratios and lack of liquidity. Remember what happened when we had the Thanksgiving holiday? The market went down about 800,000 points and then recovered pretty quickly. Lack of liquidity. So a lot of people are traveling this week. A lot of people are out of town. There's a lot less market participants because it's a fragmented week. Whenever you have a fragmented week, we've got to watch out because you've got higher volatility. You've also got earnings on Micron and a couple of stocks coming out this week, so you got to be a little cautious there as well. But don't let whatever I'm telling you fool you. The biggest catalyst right now is this Omicron, no question about it. Volatility looks like it's spiking a bit. I don't know if it's going to get to the level that we saw it during last month, before this month began. I mean, we could come up. It's been a little while. We could see a double whammy. But honestly, I think this encompassed most of the Omicron downside. So if it goes above this level, we can expect the market to break down further. But I'm not expecting it to go too much above this level. I'm not expecting this week to be too eventful. Now, I hate to say I told you so, but I've been telling you for about a month that consumer discretionary is going to come down. Looking at our cumulative strength index, technology due to chips is still up there. But look at this: real estate, healthcare. Now you have consumer discretionary. And look at what you have right below consumer discretionary. consumer staples. Remember I told you guys that with Fed raising rates, consumer discretionary is going to cool off and consumer staples are going to heat up? Let me show you 2 weeks ago or a month ago. Let's go a month ago. Look at consumer discretionary and look at consumer staples. Consumer discretionary was on the top spot. Consumer staples was on the ninth spot. And now if you look at it right now, you will see that consumer staples is in fourth spot and consumer staples is in fifth spot. But there's always a but, right? If you look at it on a monthly basis, basically telling us what's going on right now, you'll see that consumer staples is eating technology and consumer discretionary alive for breakfast. And as you could see here, healthcare, utilities, real estate, consumer staples, those are defensive sectors, and those are the ones you should be focused on right now. And the heat map will confirm that. The last 5 days, steel producers, utilities, large cap pharma, Omicron, cable TV. I don't know what this is all about. Honestly, I don't know what cable TV is all about. Maybe because stay-at-home environment, that could be it actually, now that I think about it. Staffing, that makes sense. Biotechs, wireless tech, utilities, advertising, marketing services. Again, I don't know what that's all about. Consumer staples. But as you can see here, most of these are fairly defensive. There's not a lot of tech here. And if you look at it on a 1 month basis, you will see utilities, insurance, consumer staples. These are assets that go up when stocks go down. These are defensive. So defensive stocks have been moving higher at the cost or the expense of lower price stocks, or not more speculative stocks, not lower price stocks. That was a mistake. Russell 2000, as I said, it looks like it's ready to bottom out. And the Russell 2000 is the most speculative sector. And if you look at the price of the Russell on a technical basis, you will see that it's grossly diverging between price and RSI. Price is moving lower. RSI is saying we can't move any lower, which is telling me there's a good chance we're bottoming out. Also, if you look at the SPY, if you look at the SPY, we're now the first day below the 50-day moving average. So we got to be very, very cautious. To me, this feels like a big shakeout. It doesn't feel like a big downside. And the reason for that is if I look at momentum levels, and I want to show you momentum levels. This is all the stocks in the S&P. This is all the stocks not in the S&P. These are all the stocks in the entire stock market priced above $2. It looks like it's bottoming out. It looks like momentum levels are bottoming out. RSI can't keep up with this. As you can see here, RSI is higher. This is not really lower, but kind of on the same level, but not nearly as low as this. We went to 22.34, and look at where the RSI went. We went to 23.68 or whatnot, and the RSI couldn't even go back down. That's telling us we're bottoming out, and the small caps or the Russell stocks are mimicking exactly what we're seeing here. So to me, it looks like the market is bottoming out and is trying to desperately to shake everyone out. The Dow here, as you could see here, looks like it also wants to make a double bottom, similar to what you're seeing in the Russell. Let me just go back to the Russell. Let me just go back to the Russell. See how the Russell's double bottoming below the 200-day? I think the Dow is trying to do the same. And the Dow right now is what I would be paying attention to, because the Dow has the strongest stocks, utilities, consumer staples, dividend stocks. So let's pay attention to the Dow, and I'm going to believe that we're going to bottom out here, because the RSI is doing very, very similar to what we're seeing with stocks priced, with the Russell stocks and all stocks priced above $2. Let me go back here. Sorry about that. I'm kind of all over the place right here. Sorry, you may have to watch this video a second time. I'm kind of going, but as you can see here, it looks like we're bottoming out. Actually, it looks better on a chart view. You can actually see what's going on here. But as you can see here, the candles are bottoming out, and the RSI can't sustain the low level, and that's momentum levels right here, and that's very, very similar to what we're seeing on the Russell price action right now. And the Russell, being the most speculative sector, is the one, see that divergence, is the one that I believe is going to be the most valuable, because this tends to be the most sensitive because it has smaller stocks which are more sensitive. And if you look at the QQQ is in trouble, but again, we are below momentum levels, and I don't know if this is going to be a bottom or not, but you got to be very, very, very careful right now. The bottom line is tech stocks are taking a backseat to consumer staples, utilities right now. That's what you got to pay attention to. Now I'm going to go through the global economy, kind of give you the broad strokes. I'm doing it a little backwards today. But again, to me, the market doesn't feel like it's going to go lower too much. It feels like it's going to exhibit a lot of volatility and be kind of non-directional this week, kind of a shakeout week. Maybe a little bit lower, but not too much lower. But again, I think we're going to have a shakeout, and we're going to see more upside in the defensive stocks, especially if this COVID variant continues rocking and rolling, which I don't think it will. I mean, if Delta couldn't do it to us, I think this is going to be just a bunch of smoke and mirrors and an excuse for the Fed to not take action or to push back their bond taking action. That's what I think the worst case scenario here is going to be. So expect a lot of volatility, but I'm expecting the market to bottom out and start moving up this week. Hopefully this week, especially if the GDP is a little bit on the downside, because that's going to cause the Fed to take notice and pause whatever they're doing, and it'll give them an excuse. They really want to keep the stock market higher, so I think it'll give them an excuse to keep it higher. So let's talk about global economy. Global stocks tumbled Monday. Concerns, latest COVID variant, tighter Fed policy. Boy, oh boy. COVID and tighter Fed policy just don't get along. The spread of the Omicron variant has fueled fears that renewed curbs on business and travel might worsen supply chain disruptions and boost inflation, although we haven't seen evidence of that yet. Just keep that in mind. On Friday, the S&P fell 1%. The index is 2% below its all-time highs, but it's still up 23% for the year. Travel has bid up airlines, cruise lines, other travel-related stocks on hopes that the Omicron spread wouldn't trigger more travel controls. Sentiment has turned as the U.S. and other governments warned that Omicron is more pervasive than expected, prompting travel restrictions in some areas and canceling public events. Keep in mind, we heard it was bad. We already know that it's bad, but we don't. The question mark was how bad does it impact people's lives, not how bad it infects people. I mean, the flu is contagious too, but it doesn't cause most people to die. So I think that's really the issue. The U.S. government warned Sunday of a possible surge of breakthrough infections as America travels for Christmas and New Year's Eve. Last week, stocks briefly rallied but then fell as Fed officials said Wednesday they might accelerate. Their timing is just impeccable, isn't it? The reduction of bond purchases that inject money into the financial markets, I think they're going to backpedal on this like there's no tomorrow. If the Omicron variant continues to become pervasive, that sets the stage for the Fed to begin raising interest rates next year. Again, if this Omicron if the Omicron starts causing damage, they're going to backpedal this like they've been doing the last 2 years. Also potentially waiting on sentiment is the fact that U.S. Senator said Sunday he wouldn't support President Biden's $2 trillion infrastructure. That could be a big, big pain in the butt, because a lot of the structural stocks, a lot of the infrastructure stocks, a lot of the consumer staple stocks have been going up based on that, and basic materials too. Inflation has been growing concern throughout 2021, and that's the biggest factors impacting the market. Again, I think this week we're going to be choppy. I'm not seeing that big of a spike in the bond market. I'm not seeing the volatility get out of whack just yet. I think this is going to be more of a shakeout and a lot of manipulation because there's not a lot of participants out there. Keep your eye on utilities, insurance brokers, consumer staples, power. This is defensive. This is where the upside is. Steel producers, again, utilities, pharmaceuticals, biotech, staffing as well, I guess now, because of the Omicron. So be careful and be defensive. And again, be prepared for volatility. Folks, this is not a time to use tight stop losses. I don't know if you figured that out or not yet, but if you're using tight stop losses, you are getting stopped out. Lower positions, lower exposure, get defensive, and stop trying to pick bottoms. Don't do that right now. Go for quality, go for the best stocks, and widen those stop losses. This is not a time to be a hero and try to control your risk with a 15% stop loss on an option. You will get stopped out every time. I'm telling you right now. Wide stops, broad market exposure, defensive stocks. And by the way, I just released a complimentary bootcamp training session to teach you the 3 critical components for profitable pullback trading. That's right. Just click on the link below and watch and receive your free report. Leverage new trades with high velocity pullbacks and options. It's a free report. What else can I say? All meat and potatoes. No fluff. I mean like zero fluff. It's all heavy duty trading concepts. This type of training that you'll receive is content that my students have paid as much as $5,000 for. I'm not kidding. It's the good stuff. This is the good stuff. Today, you can access it for free. It's the holidays. I want to give you guys something of real value. This isn't some marketing BS summit. This is real in-depth training. Like the kind of stuff I'm giving you in the morning videos. Heavy duty stuff. No monkey business. Don't miss out on this. No shenanigans. No hype. All heavy duty trading concepts. I would suggest that you watch it more than a few times. It'll click if you do. And as always, make sure to like this video, subscribe to this channel if you're watching on YouTube. I want you to stay ahead of the market. Be the first to do so by subscribing and watching these videos. And again, tomorrow we're going to talk about the strongest sector, strongest stock, weakest sector, weakest stock. And again, don't use tight stops right now. Don't try to time the market down to a minute right now. Volatility is driving the markets. You have to use wider stops. Let your positions breathe a little bit. I'm telling you right now, it's the only way to survive in this market. And again, if you haven't been following me for the last 2 months, I'll tell you again, it's time to switch from offensive sectors, speculative sectors, to defensive sectors. If you didn't believe me then, hopefully you'll believe me now. Have a great day. Have a great week. Send me some feedback. I want to know if I'm keeping you out of trouble. Support@marketgeeks.com. Bye, guys. Have a great day, and I'll catch you on the other side real soon. Bye.